A critical part of the whole development and the success of your property investing is getting finance. So on your team, when it comes to finance, you must always use a qualified, sophisticated mortgage broker. Now what that means is someone that's going to actively look across 15 to 20 banks for you to give you the best outcome that you need. With that in mind, they need to know your end result and what you're looking to achieve. Right? I know that I haven't got time to go and visit 15 banks by myself, and I know that because they deal in quantity, they're able to get you a better discount and a better rate than what you can do yourself on your own. Right? There are a lot of mortgage brokers out there that will get a convenient loan for them, but not necessarily the best loan for you and yourself. Right? So if you want to know the mortgage brokers that we associate with, feel free to contact me direct and I'm happy to pass that on. Critical part of finance is serviceability and buying power. So what the banks will look at is your ability to repay the loan, as in serviceability, and buying power is the cash or equity that you've got to put into the deal. Right? Now whether you're going at an 80% loan to value ratio or 90% loan to value ratio depends on your circumstance. But essentially you need the cash or equity to be able to fund the deal long before you've gone and put in offers on potential development sites. So we know that everyone's financial situation is different. We looked at a purchase price, we negotiated a price of 1.1 million. So what that meant was over across the two sites, we needed to come up with a deposit of around 220,000. We banked on about 250,000 when we combined stamp duty and legals associated with that. So then we looked at the serviceability and said, well, our combined income is around 250,000. We went back to our mortgage broker and they were comfortable that we could get finance approval based on those two figures that we provided. So in our development, a critical part of it was the valuation. Now in the investing world, valuations can make or break the deal, right? So a valuer will come out and value your property what they think it's worth. Now the key to it is having a valuation clause in your contract or a finance clause in the contract. Now you go to your solicitor and have that set up and ensure that that is in that contract that you would have with your vendor, right? If it's not and you don't get finance approval, you can be stuck with that and deal and be up for major penalties. Right. The key to our development, thankfully the valuations came in on the dollar, which meant that we could get finance approval and we were on our way. So as we mentioned before, our purchase price 1.1 million. We know that in order to put a deposit down, we've got two options. We can go in at 90% loan to value ratio or 80% loan to value ratio. So equivalent to a 10% or a 20% deposit. Now 10% is 110,000 and 20% is 220,000. We would like to actually put in a higher deposit, which gives us greater leverage to be able to borrow money to be able to build if that was going to be the case. The banks will look more favourably on us, or more banks will, greater variety, if they see that we've got less loan against the land that we're trying to build on, right? The negative of our 10% deposit would have been that we would have had to pay lender's mortgage insurance, probably to the tune of about $20,000, which only really makes the banks happy and safe and doesn't benefit us in any way. So in summary, that was the way that we went with our finance. We were happy to put in that 20% cash deposit to leave our options open. In the next video, we're actually going to show you, we're going to backtrack 6 months and show you the numbers well before we started putting in offers to build. So some pretty exciting times there to make sure that the numbers were going to stack up for us.